Pause for a moment, because what just unfolded in silver is the kind of move that looks harmless until the instant it is in taus på layers. T. On the surface, it appears like routine volatility, another push and pull inside a market that has bored investors for years. But beneath that calm exterior, silver just made a run toward a level that changes behavior, not because it is magical, but because it exposes pressure. The price surged toward the 3-digit zone that traders whisper about, institutions hedge against, and short sellers quietly fear. And right when it got uncomfortably close, the market reacted the way it always does when someone is trapped. The brakes were slammed without warning. If you already own silver, are considering buying it, or are trying to understand why this metal can sleep for years and then suddenly dominate headlines, this moment matters. Because that overnight hit was not random noise. It was a signal. And today we are breaking down what that signal actually means, what is happening beneath price action, why the $100 threshold is far more than a round number, and what comes next as the market decides whether this was a temporary reset or the setup for a much larger move. The first thing to understand is that last night was not just volatility. It was intent. Silver moved toward a psychological boundary, and selling erupted in a way that didn't resemble normal profit-taking. It felt defensive, almost urgent, as if someone needed price to retreat immediately. That distinction matters because markets behave differently when selling is driven by survival rather than strategy. But here's the part most people miss. When price was getting pushed down, another market was flashing the opposite message. The cost to borrow physical silver jumped. Lease rates rose sharply. The combination should make you stop and think. In a well-supplied, relaxed market, borrowing costs stay low. They drift near zero and barely register. But when lease rates rise while paper selling accelerates, it suggests something uncomfortable. It suggests physical supply is not as abundant as the paper market implies. Paper says sell. Physical says pay more. Those two realities rarely diverge unless stress is building underneath. This does not mean silver cannot pull back further. It absolutely can. Silver is famous for violent dips, even in powerful bull markets. It doesn't climb smoothly, it lurches, it stumbles. It terrifies holders before rewarding patience. The real question is not whether a dip can happen. The real question is what kind of dip it would be. There's a difference between a pullback that resets leverage and a breakdown that kills a trend. If you cannot tell the difference, silver will teach you the lesson the expensive way. To understand that difference, you have to look beyond charts and into market structure, because silver is not a typical commodity. It has been one of the most concentrated markets on the planet for decades. A small group of large institutions has historically held unusually large short positions relative to market size. That concentration matters. In broad, liquid markets, price discovery is messy but distributed. In concentrated markets, price can be guided through narrow corridors of control. Charts can look clean while positioning underneath is anything but. This is why technical patterns that normally work can suddenly fail in silver. When someone says a pattern predicts a certain move, the first question should be whether that pattern is operating in a free market or a managed one. Those are not the same environment. Why would anyone concentrate shorts in silver at all? The answer is often dismissed as boring hedging, but silver is not just another industrial input. It sits at the intersection of money, industry, and strategy. Industrially, silver is everywhere. Electronics, solar panels, medical equipment, advanced manufacturing. It is a small component in many systems, which makes it invisible until it is missing. Then it becomes irreplaceable. And then there is defense usage, a topic people avoid because it sounds dramatic. High-performance systems do not choose materials based on preference. They choose based on properties. Conductivity, stability, reliability under stress. Silver appears in places the average investor never sees because it works when conditions are extreme. This is not conspiracy. It is incentive analysis. If a material is strategically important, stable pricing is preferable to chaotic spikes. Combine that with a paper market that can create supply on a screen faster than physical metal can move, and you get a structure that can persist until something forces it to break. That forces delivery stress. Paper markets function smoothly as long as participants accept cash settlement. The moment too many ask for metal instead, everything changes. Recently, more contracts have stood for delivery even in periods that are usually quiet. That is behavior, not commentary. Real capital choosing metal over promises. One of the cleanest stress indicators is the relationship between spot and futures. In calm markets, futures trade above spot. That is normal. When that flips, when spot commands a premium over futures, urgency has entered the room. It signals a willingness to pay more now rather than later. That matters deeply in precious metals. Now connect that to the $100 level. The importance of that number is not superstition. It is psychology and structure colliding. Traders anchor to it, stops cluster around it, shorts feel pressure as it approaches. A move toward that level can turn discomfort into emergency. Emergency trades are not patient, they are abrupt. That is why selling can erupt suddenly and irrationally. Someone may not be trading for profit, someone may be trading to survive. At the same time, physical premiums in key Eastern markets have remained elevated. Physical metal is trading several dollars above Western paper prices. That creates a brutal arbitrage. Cheap paper exposure gets converted into physical demand elsewhere. Every dip becomes an opportunity for metal to leave the system. When price falls but physical premiums remain high, weakness may actually be transfer. From leveraged hands to unleveraged hands, from west to east. That is not bearish, that is drainage. And drainage changes outcomes. Silver can still fall, it can fall hard. But falling does not mean failing. In bull markets, silver behaves like a lion running downhill. It stumbles violently without losing direction. Short-term caution and long-term bullish structure can coexist. The mistake is confusing the two. And that brings us to the most dangerous force in silver markets, margin. Because margin is where people get wiped out even when they are right. When silver moves, leverage looks tempting. Control a lot with little, then margin requirements rise. Suddenly positions need more cash. Those without it are forced to sell at the worst moment. That forced selling pushes price lower, triggering more liquidations. It becomes a cascade. And cascades transfer metal to those waiting with cash. This is not poetry, it is mechanics. And the fundamentals do not need to change at all for this to happen. Enough leverage stress alone is sufficient. When margin rules change, opinions do not matter. Compliance does. Once forced sellers are flushed out, something predictable often happens. Price stabilizes, then snaps back sharply. Not because of magic patterns, but because serious buyers were waiting for liquidation to finish. Redistribution follows fear. This dynamic explains why silver drops feel like cliffs and recoveries feel sudden. Now imagine being a large short seller who has lived comfortably inside a controlled range for years. Every rally has been an opportunity to lean on price, trigger stops, and wait for momentum traders to give up. That strategy feels permanent until it isn't. What breaks it is not a chart. It is a shift in who is buying and why. Leveraged buyers can be scared. Manufacturers and sovereign buyers cannot. They need supply. They do not care about candles. They care about delivery. This is why regional premiums matter. If physical hubs continue paying up while paper prices are pushed down, the market is voting with money. It is saying, send metal here. That demand acts like a sponge. Each paper smash is absorbed by physical buyers who do not flinch. The danger for shorts is that sponges eventually fill. As long as the paper market can source metal when delivery is demanded, control persists. When it cannot, the story changes from pricing to plumbing. Delivery stress becomes systemic risk. This is why rumors about banks changing positions matter. When large players shift from short to long, it is rarely ideological. It is risk management. The exit begins to look crowded. History is filled with examples of institutions talking down markets right before being forced to retreat. Whether specific stories are accurate is less important than the pattern. When fear narratives peak, ask who benefits if you believe them, selling in panic hands assets to calmer participants. Another layer complicates this further. Many investors gain silver exposure through paper vehicles that track price. These products add counterparty layers. Who holds the bars? Who audits them? Who guarantees delivery? These questions feel irrelevant until trust events occur. Past manipulation cases show behavior existed at scale, fines were paid, the system continued. The lesson is not paranoia. It is awareness. Price can be pushed temporarily. Vehicles add layers, and panic transfers assets. Understanding that changes how you react. If physical flows continue draining inventory regionally, paper dips may represent opportunity, but only for those who can remain solvent and calm. This is why leverage is so dangerous. Rules can change overnight. Silver can drop $10 and then rally 12 as if nothing happened. That whip is intentional. It hunts impatience. Borrowing stress is another tell. When prices hit while borrowing costs rise, selling is likely paper heavy, while physical remains tight. Repetition of that pattern near major levels builds a roadmap. Dips likely, shakeouts likely, volatility guaranteed. Trend intact if physical indicators stay firm. This brings us back to the checkpoint. $100 is not a destination, it is a test. The market will fake out participants repeatedly. It will try to exhaust conviction. Then it will move violently when least expected. The key is watching structure rather than screens. Structure hides surprises. Trust erosion is another signal. Futures, funds, brokers all operate on trust. When trust erodes, behavior changes. Delivery is demanded, premiums rise. Liquidity becomes less important than certainty. These shifts appear in backwardation, lease rates, and urgency. Textbooks fail here. Behavior leads price, consider everyday holders. Contrary to common assumptions, crises do not always cause people to sell metals. Often they hoard them. When banks feel risky, people hold assets outside the system. When liquidity is uncertain, they hold universally liquid assets. When counterparty risk rises, they hold assets with none. This divergence explains silver's schizophrenic behavior. Paper sells, physical holds. You must decide which market you are participating in. Delivery activity has recently appeared even in normally quiet periods. That suggests intent, not speculation. Serious buyers move quietly. The market feels it before headlines do. Borrowing costs, rising from negligible levels, signal discomfort. Layer that on top of repeated paper suppression near psychological levels and strain becomes visible. Strain does not guarantee a break, but it is not comfort. Why can price still be smashed if metal is tight? Because paper markets can create temporary illusions of supply. Contracts are faster than bars. Screens move faster than warehouses. Short-term distortion is possible. Indefinite distortion is not. When delivery demand grows, gaps widen. Secondary signals matter more than candles. Premiums, lease rates, structure flips. These are harder to fake. To avoid emotional whiplash, track 3 indicators consistently. Spot versus futures structure. Lease rates, physical premiums in major hubs. When price drops, but these remain tight, the move is likely leverage driven. When price drops and these relax, demand may be cooling. This framework filters noise. The suppression conversation only matters if it informs behavior. Markets can be managed longer than expected. When management fails, moves are violent. This is why silver shocks observers. Institutions fined in the past did not vanish. Fines are costs. Incentives persist. Custodianship overlap raises trust questions again. Trust is central. So what now? Do not equate price smash with thesis failure. Do not expect straight lines. Avoid leverage where rules shift suddenly. If trading, respect risk. If holding long-term, accept pullbacks as part of the journey. Decide who you are before the market forces the choice. Margin hikes framed as risk management often pressure longs first. Expect turbulence afterward. Headlines will declare failure. Watch what follows. Zooming out, if industrial demand remains sticky and monetary uncertainty persists, silver retains tailwinds beyond any week's chart. But it tests conviction relentlessly. The challenge is staying disciplined without becoming reckless. Scaling, strategy, and core positions matter more than bravado. The simplest truth is also the hardest. The biggest money does not care about small dips. It does not use margin. It waits for forced sellers. Trying to outtrade it on its time frame is a losing game. Plans that do not require perfect timing survive. If premiums and lease rates stay elevated while paper caps price near key levels, pressure builds. Each defense becomes riskier. Eventually the defense either holds again or fails dramatically. Pressure favors resolution. If you have been accumulating quietly for years, sudden attention may feel validating. If you are new, resist chasing. This market hunts leverage and patience and certainty. Extremes get punished. Balance survives. There's one more element that ties everything together, and it is psychology. Silver does not just test capital. It tests patience, identity, and emotional discipline. When the market moves against you violently, it forces questions. Was the thesis wrong? Was the timing wrong? Or was the position structure wrong? Most people confuse these. The market exploits that confusion. When volatility spikes, people seek certainty. Silver offers none. It offers probability. Understanding that difference keeps you in the game. If delivery stress continues building, there is a line that matters more than any headline. Failure to deliver, not a rumor, not a tweet. An actual inability to source metal when required. That moment changes pricing instantly. It transforms silver from an investment narrative into a systemic concern. This is not about tomorrow. It is about awareness. When the crowd realizes what is happening, the price is already higher. Learning the rules beforehand is the advantage. Trust erosion accelerates this process. Futures rely on confidence. Funds rely on custodianship. Brokers rely on solvency. When trust weakens, behavior shifts. Physical demand rises, premiums expand, time preference flips, backwardation appears. Lease rates climb. These signals precede headlines. They do not ask for permission. They reveal urgency. Everyday holders behave differently than traders. In real stress, people cling to what they trust. They do not liquidate it casually. This is why paper selling can coexist with physical hoarding. This divergence confuses observers. It should not confuse participants. Decide which behavior you align with. Another overlooked signal is the persistence of delivery interest outside peak cycles. When deliveries increase in quiet months, it indicates planning. Someone wants metal regardless of seasonal norms. Planning suggests long horizons. Long horizons do not react to intraday candles. The argument that tight supply should prevent price suppression misunderstands mechanics. Paper can distort price briefly. It cannot fulfill obligations indefinitely. When obligations rise, strain appears. That strain leaks through secondary indicators. Those indicators matter more than noise. For practical navigation, consistency beats prediction. Track structure, borrowing costs, and premiums. Ignore emotional narratives. When indicators contradict price, price often catches up later. When indicators relax alongside price, caution increases. Debates about manipulation are only useful if they inform strategy. Management can persist longer than logic suggests. Breaks occur suddenly. Preparation matters more than outrage. History shows that fines do not eliminate incentives. They quantify them. Understanding that helps frame risk realistically. Trust is priced, not promised. Positioning choices matter. Traders respect volatility. Long-term holders respect fundamentals. Mixing approaches without clarity invites forced decisions. Decide in advance. Margin remains the silent risk. Rule changes do not negotiate. Forced selling does not care about correctness. It cares about cash. Avoiding leverage avoids ultimatums. When exchanges adjust requirements during rallies, turbulence follows. This is structural, not personal. Expect it. Plan for it. Do not react emotionally. Longer term, silver benefits from unique dual demand. Industrial usage anchors necessity. Monetary demand anchors value. Strategic demand anchors urgency. Few assets combine all three. That combination produces volatility. It also produces opportunity. Opportunity favors preparation, scaling entries, holding a core, managing exposure. These strategies outlast bravado. Large capital behaves differently. It waits, it absorbs, it does not chase. Understanding that shifts expectations. Trying to outrun it fails. Aligning with its behavior survives. If defensive selling near key levels intensifies while physical signals remain tight, the next approach may be more dramatic. Each defense increases risk. Eventually, something gives. For participants, the goal is not prediction. It is resilience. Staying solvent, staying rational, staying engaged without obsession. Silver punishes certainty. It punishes impatience. It rewards discipline. Volatility is not a bug. It is the mechanism through which ownership changes hands. Those who endure it inherit what others abandon. When price drops sharply in a tight physical environment, ask whether fundamentals changed or whether leverage was cleared. Often it is the latter. The market's job is to exhaust you. Your job is to avoid exhaustion. If the next major leg carries silver toward triple digits again, expect chaos, expect fake outs, expect fear. That is normal. The abnormal outcome would be a smooth ascent. Whether the market explodes through resistance or delivers one more brutal shake first is unknowable. Watching structure improves odds. In the end, silver is less about price and more about behavior. How participants react reveals the future faster than charts. Those who understand that do not need certainty. They need preparation. And preparation, not prediction, is what survives when the move finally arrives.